Hey, what's going on, guys? It's AJ back again with another video, and today I'm going to be talking about my perspective on investing in the stock market, specifically long-term investing. So, long-term opposed to short-term investing or even trading. Long-term investing is basically you're betting that a company that you invest in will grow over time, and basically 3 to 5 years or even longer in some cases. Some people never even sell their shares once, when they're even like 80 or whatever, 80 years old or whatnot. Basically, long-term investing is in the long run, you think that company's going to grow and that stock price is going to increase. So, with long-term investing, you probably have heard of buying low and selling high. So with the stock market, there's a share price for each company, and you can buy as many shares as you can afford for a company. And basically, once you buy in, that's you're betting that the company will go up in value, or the stock price of the company will go up in value from that point. And usually you want to invest if you think it's going to go much higher, so you can make more money, of course. So buy low, sell high. That is a good start. That's like the tip of the iceberg when it comes to stock market investing, in my opinion. That being said, you don't want to buy just any stock that's, $4 stock or whatever, because it may be a $4 stock for a reason, because it's not successful. But that being said, you should also not be scared to buy a $300 stock, because you never know, it can go up to $1,000. It really depends on how much you believe in the company. So what you should be looking for when you're investing in a company long term is that there's 4 financial statements, and you can look at these to see how the company is doing in the past year, in the past quarter, or maybe they're trending upwards. So looking at things like revenue on the income statement, if their revenues are trending upwards, and if their profits are trending upwards, obviously that means you would presume that that company is going to keep growing into the future. There's also the stockholders' equity and the cash flow statement and the balance sheet. So when you look at the balance sheet, something you want to look at is, do they have enough cash to where if there's a recession, can they still pay off their debts? So is their cash greater than their debts? But also, you don't want cash to be too high, because then it's just stagnant money, and they're not reinvesting it back into their company through innovations and whatnot, and basically bettering the company. So it's a balancing act when you're looking at the balance sheet and an income statement. Another thing that a lot of people look at when they're looking into companies is the forward PE ratio, which the PE ratio stands for price over earnings. So that's price per share, which is the stock price, over the earnings per share. And that's the earnings per share is the net income over the total number of shares outstanding for the company. And so they look at that, the forward PE. So that's not the current PE. The forward PE is the projection in the future. So the average is around 15 to 17 for a company. And, bigger companies, they have more leeway in having a slightly higher PE ratio, 20 to 25, that's fine for a bigger company. But there are some companies that are up there in the 80s for forward PE, and it may be a very good company, but how much more can it really grow? That's the question you have to be asking yourself when you're looking to invest in stocks. Speaking of innovation that I mentioned earlier, you want to see that the company is innovating. Like if it's let's say, a printing press company, or even better example is a typewriter company. Like no one really uses typewriters. I mean, sure, I use one, every week for my essays. No, I'm just kidding. Um, no one really uses typewriters anymore. So you might not want to invest in a typewriter business. You know what I'm saying? But a company like any technology company, if you think that their ideas are going to, continue in the future, those companies may have a lot of growth in store. And then off that, people also look at multiple sources of income. So take Apple, for example. They have iPhone, they have iPad, they have Mac, Apple Music, I mean, the list goes on. Facebook has, Facebook itself, Instagram, WhatsApp, So those companies have multiple income sources who are, helping to, if one sector falls or falters, they still have plenty of other sources of income. And then the final thing is like the reputation of the company. A company can be very good, but if they don't have a good reputation, then there's not going to be a lot of hype around it to push the stock price up, because the stock price can only go up if more people are buying the stock than selling it. So if there's not a lot of positivity around it, not a lot of people are going to be investing in it. You may not want, or you may want to try to convince other people to invest in it if you believe it's a very good company, or you may not want to even go with that said company, even if you do think it is, a reputable company and a fast growing company, because the stock price may be stagnant for, who knows how long. But that can change over time, and you can invest when it does change. And then, so those are the things like I look at. Most people I've heard talking about the stock market, those are the things they look at when they're trying to invest long term. So that's over at least 3 years. For most cases, at least 5 years. And then in a lot of cases, like over 10 years for some people who start earlier. It's tough to know when exactly is a good starting point to get into a stock, but you're balancing like a few dollars per share if you think the company will go up immensely over time. So if you're starting out, I'd say, go for a stock you believe in and, follows all those criteria I mentioned before. And you don't really have to get nitty gritty when it comes to, oh, this stock is $100. I can't do that. I have to wait till it goes to 98. Maybe it never goes back down to 98. You don't know. So it's better to get in, earlier, I'd say, for the most part, at least when you're starting out. And you can try to, use your experience once you're a veteran in the stock market. And, people might be asking how. Well, there's plenty of stock brokerages. I use an app called Robinhood, which you can trade for free. A lot of brokerages, almost all of them, actually you have to pay a fee every time you buy or sell shares. I use Robinhood. It's an app, you can find it in your app store. And then with Robinhood, that's the one I know most about because that's the one I use. I'd recommend it because it's free, so you don't technically have to, pay any extra fees, which is nice. Yeah, I mean, I'd recommend Robinhood. There's a link in the description if you want to sign up for Robinhood. you can get a free stock. It's random, but it's still it's still a free stock. With that being said, do you guys have any questions? Did I go over some things you didn't know about already? Or would you want me to go more in depth about some of these things? Let me know in the comments. You can give it a like if you like it. I mean, I guess that's what people do. They give it a like if they like it. Subscribe if you would like, and then I'll see you guys next time. Peace.